We are now live. So my name is Chris Berry, certified law attorney, certified financial planner with Castle Wealth Group. And we do these weekly wisdom webinars almost every Wednesday, unless something comes up. And really what these are for is just to answer questions that our clients or you may have as they come in. So these are questions that were either submitted ahead of time, or if you do have any legal, financial, or tax questions you want answered live, feel free to put that into the Q&A. And we'll go ahead and try to answer those questions as they come in. So there's nothing prepared. There's no fancy PowerPoints. When I draw on my whiteboard, it's sometimes a little messy because I'm doing this on the fly. So with that, I always like to start with a positive focus, just something positive that happened over the last week. And a lot of times it is family related. And my positive focus this week is that this Saturday, I'm going to my daughter's she participates in what's called Odyssey of the Mind, which is kind of like a STEM kind of engineering type problem solving program for younger kids. She's age 12 and they won regionals. So this week they're going to states. And so I'm pretty excited to do that. We're going over to Grand Rapids Saturday to watch her participate and hopefully she can continue on. And best part is it's like one of the things she has the most fun doing, like more than soccer or Girl Scouts or anything, is this Odyssey of the Mind, which is pretty darn cool. So I'm pretty proud of her. With that, okay. All right. So with that, the first question, and I don't have a whiteboard or anything for this, but the first question is really what's going on with like Silicon Valley Bank and all the banks right now. I want to share something real quick that I saw that was kind of made me laugh because if you haven't heard, Silicon Valley Bank and a couple other banks now have basically the federal government has seized them because people were going on a run of taking all the money out in the treasuries. They kind of invested poorly. So I saw this and I thought it was kind of funny. Silicon Valley Bank run of 2023. It's kind of funny and not funny, but it is a big concern. And I look at it whenever these types of events happen of like, what should you be doing? What are the concerns like short term? And then what are the concerns long term? So short term, the issue here is, or what happened is that these banks basically went under, the federal government seized them. And this is where we get into questions of FDIC insurance, which basically the federal government will, in certain types of accounts, insure up to $250,000. There's some different ways that you can get more than that, but basically for a specific type of account and your social security number, you can have up to $250,000 of FDIC insurance. And what that means is that if a bank does go under, and we always think of like banks and checking savings as basically risk-free. Well, this is, but that savings account that you get an interest rate, that is the risk because you get nothing in free. You either have to give up liquidity, you have to give up, you have to take on risk to get any type of growth. Those really are the two key components. The only way that you can get growth really is to either take on risk, some form of risk, even if it's very little risk, like a bank going under, and now you lose your money, or you have to give up longevity of say, hey, you take my money for a year and then I'll get an interest rate on it. Really, almost any investment, if you look at it, that's how it's made up. And it's just finding the spectrum of where are we comfortable taking on risk. And that's why we talk about diversification. So what happened is that first was Silicon Valley Bank and then a couple others went down. And the concern was people's money at these banks. And so if it was FDIC insured, then the federal government, through their promises, are going to reimburse you. If it's not FDIC insured, then what's supposed to happen is that that individual loses money. And again, that's built into the program. What the federal government has stated, though, is that for the individuals who had maybe greater than $250,000, so it wasn't FDIC insured. Now they're saying, the federal government, at least right now, is saying they're going to step in and make those individual investors whole. So that's kind of where we're at now. So short term, what should we be thinking about? Well, if you have more than $250,000 in a specific type of account, like a checking or savings account and your social security number, you may want to look at some other options. One of the things like we have right now, our high yield savings account that's offering about 4.25, it has for an individual owner $1.25 million of FDIC insurance protection. So if you're sitting on like I had a call with a client earlier today with about 400,000 sitting in cash in one specific account, and we talked about moving this money to get a better rate of return and more FDIC protection. Because if, let's say, some other banks do go under, which again, I'm not saying they will, but I would want to make sure that I have this FDIC insurance protection, because we can't depend on the federal government to come in and swipe in, knowing that we took on additional risk by not putting things in FDIC insurance and have the federal government like sweep in and rescue us. So one thing that you can do right now is look at your bigger cash accounts. And if you have more than 250 sitting in accounts, or you don't have it fully FDIC insured, make sure you get that short-term FDIC insurance protection. And like I said, right now we have high yield savings accounts online that offers 1.25 million for individual of FDIC insurance. So that's something to think about short term. Also short term, like obviously this affects the markets. So the markets don't like volatility. They don't like questions. And obviously with what's going on right now, that's raising some questions in people's minds. And so the markets have been extremely volatile and we've been talking about this really since everything dropped recently, is they're probably going to continue to be volatile until at least the next presidential election. This wasn't necessarily predicted by everyone, but we talked about how the markets were going to be volatile. And so that's where short term, take a look at your market risk that you're comfortable taking on. For a lot of our clients right now, we're looking at like buffered ETFs that offer downside protection, a buffer of say 20%. If the markets drop 20%, you don't lose anything. If they drop 25%, you would lose 5%. The trade-off is there's a cap. So if the markets go up 20%, you might only get 15%. If the market goes up 12% and the cap's 15, you would get 12%. So that's something that's liquid, kind of buys you a year of time. Also with the high yield savings accounts offering 4.25%, that buys some time. Treasury bills buy some time. Because again, the idea is to buy some time to get through this volatility. But then also just taking a step back, looking at how your money is invested based on time horizons. If this is later bucket money, yeah, things are going to go up and down, but over time, we've seen things continuously trend up. And so if this is money we're not going to touch for the next 5 to 10 years, maybe it's time to reevaluate how much risk we're willing to take on, but it's probably not a time to panic. And in fact, especially since things are down, maybe this is timed a little more to collect more of that upside going up. Not necessarily so much in bonds, because again, everything was down, but maybe looking at like low expense ETFs, or maybe some of the buffered ETFs or fixed index annuities to build in that principal protection, but then also participate in the growth that I'm sure we're going to have moving forward at some point here. We just don't know exactly when. And then the other long-term thing, what are people do? Okay. And I'll answer that in a second. So, and then the long-term concern I have isn't so much the markets. The markets are going to come back. The markets react emotionally. There's a lot of emotion going on right now. But the big concern I have is, okay, if the government is going to start bailing out banks or bailing out individuals, how much additional debt is that going to rack up? So I'm looking at this from a long-term tax perspective. Right? We know taxes are going up in 2026 because the Tax Cuts and Jobs Act is expiring. But what about the fact that we're $31 trillion in debt? We just passed a $1.7 trillion spending bill. And now what's going to happen is we're bailing out these even non-FDIC insured investors or potential of these smaller banks. So my long-term concern is with regards to taxes, because we can't keep spending money. Like, we spent a lot during the pandemic. We went from $22 trillion to $31 trillion over about 2 years. Granted, this is pandemic. This is something that's that's unexpected. But still, like, the warning signs were way before even the pandemic started. We're $22 trillion in debt. And that's why we passed the Secure Act, is to try to gather up some of that debt through people's IRAs and 401ks. So short term, look at where you have your cash stored right now. If it's greater than 250, look at some other options, whether that's like one of our high yield savings accounts that offers 1.25 million of FDIC protection, or just something else. And then short term, from a market standpoint, I wouldn't overreact right now. Yeah, it's going to be volatile. We took a dip. Now is probably not the time to sell, but it is a time to reevaluate how much risk you're willing to take on in your portfolio. And this is where maybe buffered ETFs can fit into the equation, where it protects some of the downside. Yeah, there's a cap on the upside, but if that cap's 12, 15% and you have a 20% buffer on the downside, that may make sense for at least a portion of your money, and maybe even as a bond alternative. And then getting back to the high yield savings accounts, I was on a call with, his name's Brett Danko, and he actually coaches CFPs to pass a CFP and offers continuing education. He's talking about these high yield savings accounts right now as almost another asset class. So really something to consider there. And then long term, what I would focus on is, okay, if the government's spending even more money, again, looking at those pre-tax accounts, what is my IRA exit strategy? What should I be doing if taxes are going to go up 10, 20% in the future, which they very well could? We're at the highest marginal tax rate right now is 37%. Back in 1980, which seems like a long time ago, which is top marginal tax rate was 60%. So theoretically, taxes, especially given that we're over $30 trillion in debt, taxes could easily go up 10, 20% across the board. And if you have money in these pre-tax accounts, that money just dropped. So looking at things like Roth conversions or IRA exit strategies. Okay, so here's a question that came in. What are people withdrawing cash from banks doing with their cash? Stock market is down, gold is not up a lot. Are they buying treasuries? Well, people like pulling the cash from banks. I can't tell you exactly. I wouldn't recommend necessarily pulling all your money from the banks right now. I would make sure they're in FDIC insured accounts. I had a call earlier with someone who, this was yesterday, we're going to pull money from the cash and we look at it as the stock market is down. When are you supposed to buy? You want to buy when things are down. So again, it depends on what your goals are. If you have a long time horizon, now might be the time to lean into the stock market, lean into equities. I wouldn't say necessarily bonds, because bonds aren't going to rebound the way the equities do. But now, depending on your time horizon, now might be the time to lean into the market. Yeah, it's going to be bumpy, but I would say 5-10 years from now, things will be much higher than they are now. Yeah, and the question is, stock market is down, gold is not up a lot. Yeah, I think people overemphasize like gold as a hedge, just because, like, if things really go bad, why do we value gold? Like, it looks pretty. Like, it's not food, it's not ammo, it's not guns. And so gold isn't always kind of the alternative that we think it is. Plus, if you're to try to unload gold, you're going to pay like a transaction premium on it. Like, you might buy a piece of gold for $1,000, but to sell it, you got to find someone who's going to buy it, and they're going to charge you a premium, and that your $1,000 you paid for that gold maybe is really worth $800. Are they buying treasuries? T-bills are an option. I had a call with someone today, and we're looking at T-bills versus the high yield savings accounts, or CDs versus high yield savings accounts. I'd rather keep things a little more liquid if we're talking short term. If you're looking for like short term growth, like a T-bill or a CD, just with those high yield savings accounts at like 4.25% right now, or over 4%, I'd want more liquidity, just so that if we do see an opportunity with the market, or we want to get into something else, or some people are looking at real estate, we have the option there. So, okay, let me see. Any other questions on the banks and the markets right now? Okay, again, the big thing is I wouldn't panic. Short term, look at your cash savings accounts. Don't have more than 250 and make sure you have full FDIC protection. Maybe look at high yield savings accounts that offer more FDIC protection. I wouldn't really lock things up in CDs right now. Or treasury bills can make sense as part of a portfolio, but again, you're locking the money up for a period of time. If possible, I would look to equities right now, just because yes, everything's down and then like double down because of what's going on in the volatility. But again, it's going to depend on what your goals are. And that's why for the clients that we work with, I always try to step back and look at the overall plan. It's not so much about how everything's doing on a specific day, but looking at how these events affect the overall plan. So like, what are the goals? Then let's figure out the strategies and then pick the right tools. And things like high yield savings accounts or treasury bills or those buffered ETFs, those are just tools. We need to figure out what are you trying to accomplish and what are your goals at the end of the day. Okay. All right. And then I had a question come in. Let me pull it up real quick. Yeah, so the question is, excuse me, are qualified charitable distributions taxable in Michigan? So the question is, are qualified charitable distributions taxable in Michigan? So first, what is a qualified charitable distribution? It's basically once you're over the age of 70 and a half, you can take pre-tax dollars like your IRA money. Even if you don't have RMDs right now, you can send that money, a portion of that money directly to a charity. So if you're donating to church or the Alzheimer's Association or the Humane Society, you could take post-tax dollars from your checking account and write a check and have that go to the charity. That counts as a charitable gift, but especially with the standard deductions we have these days, you might not be getting the tax benefit from that. So a better alternative would be looking at those qualified charitable distribution or looking at your IRA money. So whenever you take money, almost whenever you take money out of an IRA, it is taxed. You have to pay income tax. And that's what we're talking about with regards to if taxes go up, the amount of tax when you pull that money out is greater. So right now you might be taxed at 22% federally if you're to pull the money out of the IRA and 4.25% state. But if taxes go up 10%, now you're going to be taxed at 32% federally and then whatever it is state, meaning you're going to get less value for what you have inside of those pre-tax accounts. Think about like a mortgage. You have a mortgage with the IRS on those pre-tax accounts, and it's an adjustable rate mortgage. And we know the taxes are being adjusted up in the future. So I would rather look at paying the tax sooner rather than later. So getting back to the qualified charitable distribution, one way to get around paying that tax is send a qualified charitable distribution, whatever you're going to pull out from that IRA, send it directly to the charity. So it's not to you and then to the charity. It has to be directly from the charity. Like we could set up a checking account or a checkbook from your IRA to then write a check to your church or check to the charity. And now that actually lowers your taxes. So that is one of the best ways, along with maybe donor advised funds, to donate to charities these days is through these qualified charitable distributions. So they're federally tax-free. And then in most states, including Michigan, they're also state tax-free. So you don't have to pay tax on those qualified charitable distributions. That's the big benefit. I'll have to double check with our CPA, but I'm like 98%, 95% sure that your QCDs in Michigan are also state income tax-free. Worst case, if they're not, it's a 4.25% tax. The big thing we're trying to avoid is the federal tax, which could be 10, 12, 22, 24, 32, 35, 37%. So, all right. Okay, any other questions? Those are the big two things I wanted to talk about. All right, so with that, thank you, everyone. Make it a great week. Bye-bye, bye-bye, bye-bye.